House, senior economist with Wells Fargo's Corporate and Investment Bank. And today I'm joined by my colleague, Michael Puglisi, to talk about what rising interest rates mean for the national debt. Michael, why don't you first start off by bringing us up to speed on how the national debt has evolved over the course of the pandemic?
Yeah, so the national debt has increased pretty significantly over the past 2 years. The debt to GDP ratio in the United States was right around 80% when the pandemic began, and it's just under 100% now. So if you think about that in dollar terms, about 25 cents for every dollar of the national debt has been created over the past couple years. But despite all of that increase in debt, we haven't really seen interest spending go up all that much because interest rates have been very low for the past 2 years. So the Fed cut the federal funds rate all the way to 0% right at the onset of the pandemic. It's only recently begun raising that. And of course, Treasury yields followed that and were very low for the past couple years. And so even though we've seen that big increase in debt over the past couple years, you've seen interest spending as a share of GDP in the United States stay pretty low for the federal government.
But in more recent months, we have seen interest rates rise, and they're expected to rise even further. So how should we think about that rising rate environment in the context of the national debt?
Yeah, so I think there's a couple important things to keep in mind when thinking about the connection between rising rates and the interest spending for the government. So one is that most of the Treasury market is fixed rate debt. So only about 3% of U.S. Treasuries are floating rate debt, with another 7% or so having interest rates that are tied to inflation rates. So 90% or so of the Treasury market and the national debt is fixed rate. So that's not going to reset every time rates move around on a day-to-day basis. And then the second important thing to keep in mind is that not all debt comes due at any given moment. So the weighted average maturity for the Treasury market is about 6 years. So you're not talking about all of that $24 trillion debt resetting each year. Still, though, that means if there's a sustained increase in interest rates over a several-year period, 3, 4, 5, 6 years, a lot of that debt is going to have to be refinanced. And so if you had a sustained increase in rates, you potentially would see much higher interest costs for the federal government, given that weighted average maturity of 6 years or so.
So what's your base case for federal interest spending over the next couple years then?
Yeah, so I think federal interest spending is going to go up pretty substantially as the Fed tightens monetary policy. We've got the Fed funds rate peaking out at about 3.5 to 3.75 in 2023. We've got Treasury yields in that 3 to 3.5% range later this year and into 2023. And so against that backdrop, I think you're going to see net interest spending on the national debt rise to about 2% or maybe even a little bit above 2% of GDP. Now that would be more than we've seen in the past couple Fed tightening cycles, so that would be a greater interest spending as a share of the economy than we saw from 2015 to 2019 when the Fed was tightening policy, and in 2004, 2006 when the Fed funds rate got all the way up to 5%, a little above 5%, but of course the national debt was a lot lower at that point in time. I still think it will be manageable, though. 2% of GDP is less than the highs we saw in the 80s and 90s when interest rates were a lot higher and debt was a little bit higher, and so that you had interest spending at that time that was even at 3% of the economy, so a lot more than we're expecting over the next year or two. And at the same time, in the near term, the deficit itself has gotten a lot smaller as COVID relief spending has wound down, as the economy's been very robust, as the labor market's performed well. Asset price returns have been very good until recently, and that's led to very strong tax receipts. So in the near term, I think you'll see net interest spending go up a lot, but stay very manageable and still be well below the highs that we saw in the 80s and 90s.
Okay, well, that's helpful background for the near term, but what about the medium to longer term?
Yeah, so when you think about the medium to longer run fiscal outlook broadly, and specifically as it relates to interest spending, there are really two key factors you need to think about. One, what are longer run interest rates going to be? And I think it's our expectation that 3 to 3.5% Treasury yields probably aren't going to be sustained, just like the Fed funds rate is going to be at 3 and 3.75, but not on an indefinite basis. So we've got the Fed reversing course on rates in the end of 2023 as they potentially move interest rates closer to neutral, which I think 2.25, 2.5 is a reasonable estimate for what that longer run kind of steady state Fed funds rate should be. So if that's right, then that should be an environment where net interest spending eases a little bit on the other side of these much higher rates we're going to see in the near term. But of course, there's a lot of uncertainty right now. We could, get a situation where interest rates have to be a lot higher for a lot longer to bring down the inflation that we've seen over the past year or so. So I think the economic situation lends itself to the potential for a tail risk there where rates are a lot higher than expected, and that would of course create a lot of upside risk to financing costs for the federal government. And then the second area of concern would just be medium to longer run primary budget deficits, which is the deficit excluding interest spending, are set to increase pretty substantially, particularly as a result of the aging of the population and more spending on programs like Social Security and Medicare. And so if you take a longer horizon of 10 to 15 years out, we're potentially looking at much bigger primary budget deficits that will be harder to finance all else equal. So I'm not as concerned about financing costs in the near term, even with rates potentially going a lot higher over the next year. If I do have any concerns, it's really more about that medium to longer term outlook given the uncertainty around longer term interest rates and what those medium to longer term primary federal budget deficits will look like.
Well, thanks, Mike, for joining me to discuss such an important topic. And from all of us at Wells Fargo, thanks for tuning in to our latest economic insights.